taxes, and a lot of finance became so important for businesses, for people, for government, and actually everyone else around. Okay, so now I'm going to ask you guys a question. Okay, now that we have a very brief history about finance, I'm going to ask you guys a question, and that is basically asking you all, there is three types of finances. Do you all know the three types of finances? It's right here also. Who can tell me? Marjorie?
Yes,
Hi. Do you know the three categories of finances, or have you heard of it?
it's the public finance,
Yes.
corporate finance, and personal finance.
Absolutely. So if you were going, Marjorie, can I ask you one more question? Is that okay?
Sh- Sure, mom, no problem.
If I was going to ask you, when you have to manage uh, your salary that you get, and
Mm-hmm.
you have to make sure that you have enough, to last for the month till you get the next salary. What kind of finance is that, Marjorie?
I think it's my own personal finance.
Absolutely, absolutely. It's your own personal finance, right? So
Yeah,
that is basically personal finance is when you manage your own salary, own profits, and own losses. It's everything to do with you. Okay. So
yeah,
you household income, budgets, whether you need insurance, even whether you can do a course or not. It's all about financial planning, right? That is
yes, yes.
individual. Thank you so much, Marjorie.
Welcome, mom. Thank you.
Welcome. Someone else put their hands up, and then is it Ekon? If, okay, if you have a question or if you want to answer any of these questions, please do. Please, please feel free to put your mics on and talk. Okay. Now we talk about corporate finance. What is corporate finance? Oh, before we go to corporate finance, I'm going to ask you guys, what is public finance? Because personal finance came first, and then public finance, and then the corporate finance. Okay. It's all came simultaneously, but if you really want to think about the oldest ones, what is public finance? Ikon, would you like to answer? Christina, Cheryl, Tran. Can I call you Tran if or Joyce?
Yes, ma'am. Please call me Joyce.
Oh,
Okay. I think corporate finance is uh, manage your like asset revenue, or if the company have debt, so that company must to organize them or take the control of that.
yes, definitely. Definitely, Joyce. You're doing really well. It is all about managing the debt, making sure what has to go up. If you're managing debt, what do you need to make sure you build up on? Your revenue, right?
Yes.
So you build up your revenue, you increase, you manage your assets, and make sure you make profit. All that is corporate finance. It's a whole lot of making sure the company makes a profit, and long term it makes what we will discuss later is what we call wealth, is like, making sure that the shareholders of the company, if there are shareholders, if it's a small business, then there won't be many shareholders, but making sure that it's lucrative or viable, or it's making money in a very basic term, making money. Thank you so much, Joyce. You're absolutely right. Do you want to give a try for what public finance is about also, Joyce?
Public finance. So the first thing in my head tax. So we have to pay tax. Maybe we buy something and we borrow the money
Mm-hmm.
and that a debt. Um, in my country, we don't have any. I don't have any pay for like government or something like that. So it's just a tax and
Okay.
debt.
Mm-hmm. Definitely. That is taxes exactly what public finance is all about. So that's a way kind of how the government or what we will talk about is a macro system, the larger uh, aspects earn money. So the government will have taxes. And not only that, when we talk about finance, we're not just talking about where you gain money, you have to manage your expenditures also. So you'll have government expenditures. So they have you guys all heard about the budget where the government and the parliaments meet up and they talk and they discuss about the budget planning. That's a very big event because you're talking about billions and even trillions of dollars. And because of that, government expenditure is very important. Okay, budget procedures. That what we talk about budget procedures is basically how the government makes a budget, how the public sector makes uh, the budgets for whatever they are going to be doing. Okay. Do you have any other examples for public finance, Joyce?
Yes. Any example?
Mhm.
Okay. I buy a laptop for my work or study, so I don't have enough money for full payment, right? So I
Mhm.
have to borrow the money from any kind of company, and I pay it like month by month, you know. So
Mhm.
for me, it's a debt issue, and talk about how we controlling what we're spending or what we earning or gaining. I think my plan, I'm not doing well, you know, I'm not doing well. I spend all my money, but um, we have to think about it with if we want to grow a company.
Mhm.
Uh, so in my opinion, I think I save money for buy what I want, not using any debt, you know.
I agree, Joyce. I like your example because it goes across to all these three: public, corporate, and personal. Thank you for the example because, say, now if it's in a personal level, when you come to finances, personal finances, it's definitely you buying your the laptop and you don't have enough money. So you're going to go borrow it and you have to first think, do you need the laptop? What kind of laptop do you need? How much can you afford monthly payments, right? Same thing if you're going for corporate also has to think, is it do they need that kind of assets? What is the depreciation value of this asset? Is it worth going in? When they go for the bank, are they going to? So these are all finances, right? It's not just buying it or getting the money, it is how you manage in between. And public, say we are going to use the same thing, same example of Joyce's computer. Now Joyce is going to be the one who's making a decision in the public sector. She's going to be doing some, buying computers there. We'll imagine that, Joyce. Okay. And then you have to make a budget there and think, can the government afford? Is it within the budget that they have planned? Because in a public financing, you can't just go by. In personal, you can, but public, you can't. You have to justify every single thing you do, and it has to be passed by so many people. So that there is management, okay, because it's mostly the taxpayers and government revenues that are being utilized, and so is a corporate. You can't just go buy a computer. It has to be passed out, and the finance division, which we're going to talk about, is going to see whether yes, yeah, Joyce needs a computer, or no, Joyce don't need the computer. Okay, thank you so much, Joyce, for the lovely example.
Yeah.
And then we go into advances in accounting. Okay, so we have something called compound interest. Compound interest is where interest is calculated not just on the money, that money you borrowed. Now I'm going to go back to Joyce's computer. Okay, so compound interest is very important when it comes to finances. And why is it? Because it is where you have your what you borrow, what we call the capital, and then from there you get interest. And then from that interest, if it's not paid properly, you have more interest added to it. And it also goes back in date, okay? In be it it goes like this says, all the way to Babylonians, where interest on interest, which basically is what it is. You have your capital, and then on that, if you have interest, and if you can't pay that interest, there will be interest on in that interest, and that will accumulate and accumulate a lot. And that also you have to really think. That's why you really need to know whether, yes, I'm going to purchase it, or no, I'm not going to purchase it. Okay. And yes, I'm going to borrow that money, or no, I'm not going to borrow that money, or yes, we're going to make that investment or not. Okay. So that is where it becomes very, very important. Okay. So here again, there are so many advances as finances grew. Accounting became so important, that the bookkeepers of the in different kingdoms, they had separate areas for accountants, financiers. Okay, they kept them where they would manage the kings and the queens properties and accounting, each um, ladies and lords in England and in all these other places which had aristocracy, which owned land, would have their own accountants managing the estates. Then we go to Asia, which all our kings and queens had everything managed, from how many grains, how many bags of grains, to how much of vegetables, to how much of gold they had, and how should they purchase, is it lucrative. They even went to the depth of looking into whether you should go, the cost of war, things like that was always there. And it grew as civilization changed and it became into industrialization and everything. Accounting also advanced and advanced. Okay. With that, something happened. What happened is we came from economics and we had finance, and suddenly we had two branches. They're not exactly alike, but at the same time, they are not very different either. They depend on each other. Okay, they are different disciplines, but they depend on each other to support each other. What is economics? Economics, by the way, guys, are social sciences. Okay, it's a part of the social science group. But we are talking about economics. Economics, when we think about it, don't what's the first thing that comes into your mind when you think about economics? Who can tell me what comes into your mind? First thing. Cicely, what about you? David?
First things first, when I
Yes, Cicely,
heard
go ahead.
economics, it means the market.
So economics means market. Okay, can I ask you why you think of the market when you think of economics?
Because it's like in a country, if
Mm-hmm.
the economics go down, well,
Mm-hmm.
it means the markets go down.
You're right. We talk about the GDP, the macroeconomics, all these kind of things, right?
Yes,
Yes, you're right. It's a market. It's a buying and selling of things, and uh, about what should be invested where and how it's going to affect everybody and things like that. Okay. So thank you, Cicely. Okay. I hope I pronounced your name right. If I didn't, please correct me. I'm bad with names.
it's right.
Thank you. Okay, so first, now we're talking about. So I really like your answer, Cicely, where you said when you think about economics, it really comes into your mind about the market, and what we do out there. Okay, so what does it come to your mind when we talk about finance?
Finance, it's general, like the public, the personal, and the corporate. Everything in finance there, like in everyday life, in our everyday life, there is a finance.
Yes.
So that's what I think.
Absolutely. In every day of our lives, there's finance. And especially in some ways, in every day of our lives, we have economic also, right? Whether, how is it going to affect us and things like that. But you're right. Every day of our life, there's a finance. Okay. And so that finance is always to do with money and everyday money. How do you manage money and techniques and tools to manage money? All this is finances, right? But they both evaluate risk and return. They both, okay, here, both economic and finance also focus on how companies and investors evaluate risk and return. Okay, risk and return. So they are going to so they are going to monitor the market. That is basically economics. They're going to monitor the market and they're going to see whether it's going to look good or bad. What's the GDP about? Is it going into recession or not? All these things are there, and that's what we're going to talk about. How does the world around us focus on make sure okay, guys, if y'all are not going to say anything, please put it mute. But if not, definitely y'all are welcome to say something. Okay. So both economics and finance look at basically how companies and investors evaluate risk and return and how whether they should invest something or not. Or
Ms.
okay.
Niroshika, you need to mute all the participants.
Yes. They are all muted. Okay, so that is the basic difference of economics and finance. Who else can tell me what's the difference between the economics and finance? Who else can tell me? Here I saw. Soin Collins, finance is the science of study of the management of funds. Yes, absolutely right. Can I call you Collins? Is that okay? Uh, definitely. Joyce, go right ahead. I saw your hands up. If you...
Yes. In my opinion, finance and economy is like go to one purpose, but a different way. Okay, like economic finance is flowing economic. For my opinion, if economic is like a big word, and the people live in that word is finance. So
They're
that's
very
my
well
opinion.
explained. I liked your explanation, Joyce. Okay.
Thank
For
you.
everyone else to hear, would you say it one more time so that they will catch it? It's very well explained.
Yes, I think finance and economic is go to like a one purpose, but like a different way. Economic is the big world, and the people live in that world is finance. Finance flowing in economic, so it's not live without each other.
Absolutely. Thank you again. Thank you for repeating it also, Joyce. Okay. It was a
Yes.
really well said. So economics is what we have, what we call the macroeconomics version of it and the micro. But to manage the economics, we need finance. So they always go hand to hand, right? Even though finance is not considered a social science subject and economics is considered a social sciences subject, the fact that they are together and they are basically they help each other, they complement each other. Okay, that's why when we talk about finance we have to talk about economics, and when we talk about economics we have to talk about finance, because they really complement each other and you can't make decisions without the other one. Okay, finance, you can't make decisions without economics and looking into the market, looking into, so you say, for example, you're going to invest somewhere. You have to look at the overall economy of the country. You need to look at the strategies that has been used by the company. You need to look at it in a macro level. That is a big area. That is the big area, like everything that is, you know, beyond beyond the company itself, and then you have to look at the micro area. Micro area is a company, is the individual, is the smaller area that is going to be affected by it. And then after you look at these, you look at the finances, which is money incoming, money outgoing, money spending, all these things. And then you're going to see, okay, am I going to invest on this or am I not? Any multinational company does this kind of evaluations and assessments to make sure that their end goal of making profit is going to be realistic. Because why do you have a business? Why do you have a company? In the end, it's to make profit and to gain value and to create wealth. Okay. Even if it's, say, a non-profit, even though you need to function the non-profit, uh, and to function it, you need a certain amount of inflow of cash. And again, you need to think about finance and economics combined together. So always remember that finance does not work on its own, and neither does economics work on its own. Economics works with finance, and finance, it's like two best friends. Okay, think of your best friend, and where you're going to do everything together and you don't want to go anywhere without that person. Finance and economics is like that. Okay, so here focuses on the price, interest rates, money flows, and thinking broadly. Economics study on production, consumption, distribution, markets, all these kind of things. So again, it really, really works together. Okay, then we have what we call the finance activities. Okay, what is finance activities? Finance activities are activities that companies undertake to help achieve their economic goals and objectives. Okay, before I go into finance activities, have everyone downloaded the slides? Has everyone downloaded the slides? If not, let me just put it again. Okay. Just give me a second. Oh, great, Dan. There you go, Baptist. Okay. So, Dan, can I ask you a question? What is finance activities?
Yes, madam. Good evening. Good evening, madam.
Good evening. Good evening.
Yes, I'm from Bhutan, madam.
Oh, nice.
Yes, ma'am. Finance, as per my point of view, finance is like you know what to say now. Finance is that which is investing in the business
Mm-hmm.
and also investing in the particular business.
Investing in a particular business. Thank you so much, Dan. Absolutely. So finance activities, building on what Dan, you just told me, is that how are you going to invest? How do you undertake? How are you going to achieve these economic goals of growth, market, capturing the market, making sure you go and become global, all these things, how are you going to achieve it is all about finance activities, financial activities that are the company undertake to achieve the company undertakes to help achieve their economic goals and objectives. Thank you so much, Dan, for the example. Then they also include events and transactions that affect the business equity, long-term liability, those all matter in finance, included matter in the financial activities. Okay. So also anything to do with movement of money, cash flow, cash outflow, cash inflow. So you have to really, when it comes to a business and finances, it is very important about the cash inflows, the cash outflows. A business can be made or broken if you don't have cash inflows and cash, if you don't manage your cash inflows and cash outflows properly. Okay, what if you, if you can't manage your cash flows, inflows and outflows, what one day you might have too much expenditure. Or what can happen is that if you don't spend on the right equipment to develop your company, you're never going to grow. So it goes both ways. You know, a lot of people think that, yes, we only have to worry about cash inflow and minimize the cash outflow. But, you know, cash outflow sometimes is necessary to grow your business. For example, say when Tata Motors wants to grow their company, their automotive industry, if they just stuck to India and only in India, what would happen? They will never be big. They will never be global. So what did they do? They analyzed it. They studied the economics of it, the market, what we call. Okay, and so where is the best place to invest so that they would grow. And then they went globally, and then they went and they have now become a global giant, right? So investing is as important. Cash inflows, those are part of finance activities. And outflows, again, it has to be managed, and that process is part of the finance activities. Okay, finance also defines as the management of money, like all of you, most of you said, know about it. And also finance activities are transactions involving long-term liabilities. Okay, so what is long-term liabilities? What's the difference between the long-term liability and, good evening, May. What is the finance activities when it comes to long-term liabilities? Who can explain to me what a long-term liability is all about? Anyone? Long-term liability is something that you have invested in, but you need, in a very basic way, I'm telling it to you, okay? In a very, very basic way, long-term liability is something that you are liable for, you need to pay for a long time, okay? Then we have owners. Go ahead, Marjorie. Marjorie, you can go ahead.
Okay. Oh, sorry. I will give some example of long-term liabilities, like in our country we are buying some condo unit. Do you know that, mom? It's like an apartment.
Mm-hmm.
And yeah, like me, I'm buying an apartment in the Philippines,
Okay.
and I'm paying that for 15 years.
Oh, yeah.
And then after they return over to me, I can rent that to the people, so that monthly the payment that I don't know how to say this, that the people who rent to me, I can pay that to the company where I buy that unit. So for the example, I can give you that example for long-term liabilities.
Thank you, Marjorie.
It's for, and yeah.
It is actually, you're correct. It is a long-term liability. Why? Because there for 15 years, you have committed yourself, and you now need to make sure that you can honor your commitment, right? You have to make sure you make the payments for your condo, right? So that's a very good example, Marjorie. Thank you so much, right? So then we go ahead, Joyce.
I'm sorry, I take a while, so I don't really hear about a friend saying. So can you repeat it for me?
Oh, sure. What Marjorie said, Marjorie, correct me if I'm wrong, is that she gave an example, a very good example for long-term liability, and that is buying a condo, and she has to pay for it. She's committed for 15 years, and that means it's very long. You know, she has to make sure that she has enough earnings to make sure that she is able to pay for it. Okay, so it's like a very long-term commitment, I would say. All right. Is that correct, Marjorie? Did I tell that correctly?
Yes, it's correct, ma'am.
Thank you so much, Marjorie.
Mm,
That is,
welcome.
all these things are basically finance activities, cash inflow, outflow, equity, liabilities, short-term borrowing. Okay. Short-term borrowing is where you borrow for businesses, especially you need to borrow, you sometimes need suddenly amount of cash to be paid off. So say you're going to be, so I'm just going to pick one of your names. I am sorry if I don't pronounce it properly. Okay, May. May has decided to import to where she's staying a whole lot of, she's going to import chocolates. Okay. So her company is going to bring a container from Switzerland all the way. May, where do you live? Okay. So depending on where May lives, they're going to bring a chocolate container from Switzerland to her place so that she can sell and make a profit. But now she doesn't have enough money to buy these chocolates and put it in a container and bring it here. So what does she do? She takes a short-term loan. Okay. Short-term loan is where you're going to tell the bank, okay, I need $100,000 to buy, and you have to explain why. So you're going to say $100,000 to buy chocolate, so I can bring it over to over here, and I'm going to sell the money. And within 6 months or 3 months or 1 year or 2 years, I'm going to pay for it. Okay. So these are all things that happens in a business so that the business could grow. And managing it is the most important thing, because if you don't manage it properly, then your business is not going to be profitable, and that's where finance activities become so very important. Okay, so here finance activities, they include issuing bonds. Okay, salary of sales of treasury stock, loan from financial institutions, repayment of loans, cash from stocks, dividends. What is dividends actually? Dividends, anyone wants to tell me what dividends is? What is dividends? Go ahead, Lydia. I hope I pronounced your name correctly.
Hello.
Hello, Lydia.
Good evening.
Good evening.
Please, dividend is interest on shares.
Interest on sales.
On shares, yeah.
Yes. And also what we will give to the stockholders. What about the payments of what we are going to get the profit? And when we are earning a profit, then we give to the stockholders, Lydia. That's dividends, where you're going to, sales is right. Okay, then you're going to take that money that you have earned, and then you're going to get to your stockholders and give dividends to them. That is, from all what you're earning, you're going to give your stockholders. That is basically the ones who are financing it. Okay, buying your stocks. Okay, Joyce, I saw your hand up. Thank you so much, Lydia. You're there. You were almost there. Absolutely. Okay, I thought Joyce put her hand up. Okay, so
Sorry, my connect is not so fast. Okay.
no problem, Joyce.
I have the same idea with you, and the dividend with me, like, you know, in the stock market, and you buy enough like enough stock, you can have 1% or one dividend, you know. So beside that, you can like so like you should share the money with the company, and you become a shareholder. You still have the dividend, and we have too much way to earn a dividend, but easy way is buying stock, and enough the stock, you will become the dividend.
Absolutely.
And the dividend make you besides stock, like you earn stock and after the economic going up, you have like more money. Beside that, the dividend give you some another money too, like that.
I agree what you're saying, right? Dividend is the best way to earn a dividend is through stockholders. So it is what, so the stockholders are people who invest, who buys these shares in your company, in the company. So if you have a big company, what we call the public companies, then you can buy shares. Anyone could buy in the stock market, what we call it in the stock market. And in smaller companies, you'll have different shares and you would buy certain different shares, not through the stock market, but there is ways and means of buying it. After you become a stockholder, it's as if you own a small piece of that company. And so if you get a percentage of its profit, it's paid as dividends. It's like whatever the certain percentage of your profit that is earned, that goes to the the stockholders. What we are going to talk about is what we call wealth. And wealth, when you add that, that is you're growing your company. The more stockholders you have, the more your company is going to grow, and you're going to be paying these kind of stockholders. It's like a small percentage of this earnings that you have had, and which is what we call dividends. Then other ways of finance activities is uh, definitely when we are having power cuts. Okay, sorry, I saw a message from me. That's why I got distracted. And you get the redemptions of bond and so on. These are all different finances activities, and these are there to make sure the cash is inflow, cash outflow, and make sure that the company is going the right direction to grow. Okay, this is how it's done. Then we have what we call financial management. Now we have all these activities, right? Why, when we have these activities, we are talking about all these activities about cash flow, cash dividends, cash inflow, all these kind of things that we're talking about. Now we need to manage it. What goes out, what comes in, what should we buy, what shouldn't we buy? All these has to be talked about. Okay, and that's where the real topic of this class comes in. It's about financial management. But to understand financial management, you need to know what finance is, you need to know what activities are included in finance, and you need to know how economy plays a role in it. You really need to understand. It's like the base of it. Okay. So what exactly is financial management? Okay, financial management means planning, organizing, controlling financial activities that we're talking about, and making sure that the funds you have is utilized to the maximum so that your company or the company itself or you as a person, okay, or a government as a public entity grows. So when we say financial management, yes, we talk about the business, and yes, we are talking about how a company should manage their finances. But at the same time, you have to understand that this could apply in some ways about personally also. Remember, we talked about personal finance also. But right now, we're going to focus mainly on business. Okay. So in business, we're going to talk about financial management is basically we're saying how are we going to use what we have to make it grow in the, and how are we going to use what we have the best possible manner. Okay, so you can have you all ever heard of Subway sandwiches and how they started, or McDonald's and how they started, or KFC? You know, he was in his, I think, 60s or 70s when uh, KFC started, right? And Subway sandwiches were started in the subway of in New York, in United States of America. A person who needed a college dropout or a college graduate, somebody who wanted money, and he just started making sandwiches and started selling in the subway because he knew people were hungry when they came from work, right? And now it's a global franchise. Okay, it's a multinational company. Okay, so it's all about finance management. How much do you spend, how much don't you spend, where do you invest, how do you invest, all these kind of things play a role. Okay, So what is the scope? That is what is included when we say scope or elements, what is included in finance management? What's included in finance management is investment decisions, finance decisions. Can anyone tell me what exactly is investment decisions and what is financial decisions? Investment decisions. Anyone who would like to tell me what investment decision is about? If you can't put your mics on, you can. Oh, Dan, go ahead.
Yes, madam. Financial decision, no, madam.
Mm-hmm. Financial decisions. Sorry, financial decision. Sorry, Dan.
Yes. Financial decision is to we have to think beforehand itself where to invest and how to invest, and from investing how we get return back the actual investment.
Definitely. So how do you invest, right? How do you invest?
Yes.
Definitely that. Okay. So how do you invest on fixed assets? How do you invest on current assets? How, if you're buying a
And
machine? Yeah, go ahead,
and
Dan.
also need to do a budgeting planning, madam, in particular place, particular business.
What did you, I couldn't get it. Can you tell me again, please? Sorry.
Budgeting planning,
Ah,
madam.
positive plan. Yes. Okay, definitely. So you need to do
In particular business, madam.
in a particular business. So it depends on which business, but each day
Yes.
business, each business.
After
Yeah, go ahead.
after analyzing the marketing,
Mm-hmm.
the consumers,
Yeah.
after analyzing the market and consumers, and after that we have to study very well, and then only we'll do the financing.
Absolutely. We have to study the basically the business model. We need to study the market. We need to study the finances, everything. Then we are going to have a costing down the future, costing planning, whether it's profitable or not. All that is going before you go into investment decisions, right? Thank you so much,
Yes.
Dan. Absolutely correct. Okay. So
Thank
you're
you.
going
Thank
to
you.
you're welcome, Dan. So basically, when you're looking into investment decisions, you have different things you're going to be. Soralia, do you want to say have an example or say something? Go ahead.
Okay. Am I loud and clear?
Yes, I can hear you, Soralia.
Yeah, for me, my short definition of investment decision is on it's all about our decision on where to invest our finances. For
Mhm.
example, we want to invest on our health,
Yes,
businesses, and then how to diversify our finances like that. So we have to make a firm decision on how to invest, or on investment means on how to use our hard-earned money, something like that. So investment is we will put that a certain amount in a certain diversified business, or anything that we could say that we will earn a profit in the future. So that's on how we invest our finances.
absolutely, absolutely. That's a nice way of. Thank you so much, Soralia. Meridian?
Yes, hello, I'm audible.
Yes, you are. I could hear you. Go ahead.
Okay. The financing decisions, it means it also about the source from where the capital can be raised. And the source of it is the owner's funds include share capitals, retained earning, and whereas the ventures, loans, bonds are included in the borrow fund. And the function of financing decision is include an inflow of cash. And the decision is how much debt and equity sales went to pay in dividend. However, the investment decisions regarding as the investment of fund for getting maximum benefits for the firm, and it's long-term capital decisions related to buying machineries for productions, purchase of land, and building for expansion.
Mhm.
And then the functions of investment decision is include of outflow of cash, and the capital decisions related to buying the inventory like stocks and expenses for day-to-day activities.
Definitely, Miranda. So basically, yeah, finance decisions is whether you're going to what where you're going to get the money from, how long is it the financing, how much is it going to cost with overall things. All this goes into finance. Investment is before you invest on an asset, you're going to really look at it and see, okay, how much is the budget, the capital you need, how much is the depreciation values, and all these things you're going to consider before that. Okay, so thank you guys so much. It was really good. I loved your explanations, Meridian, everyone else, Dan. Y'all really got the point about investment decisions and financial decisions. Then we have dividend decisions. Now, we were just talking about dividend decisions. Okay, they need to take a decision. So the finance management has to see when are you going to pay dividends or not? Are you is it, how are you going to distribute these dividends? Is the company able to, are they making enough profit to be made, is it able to pay these dividends? Okay. So how are you going to do that? You're really going to look at the net profit, and you can see, okay, after all this, yes, we can actually contribute some money and contribute a certain percentage of the profit to dividends. And is it or is it not, is definitely a financial management. Okay, so here net profits are generally divided into two: dividends for shareholders, retained profits. Okay, dividends for shareholders and retained profit. That is what, so you have profit. Okay, you have net profit. Net profit is pure profit. Okay, where you have everything has been you have all expenses, everything has been removed from it, and this is the profit, the pure profit you have got is net profit. Okay, and here you have the profit, and we'll just put it as PR. Then you're going to, as a financial management team, say all of you are in the financial management team, what are you going to do? You're going to decide how much is going to be uh, allocated for dividends for shareholders, and how much is going to be retained for profits. Okay, so how retained for profits is that you can't use every net profit you have, because you need uh, a certain amount of money that is available in for future investments, to make sure payments are done in case there is some issue like a government unforeseen situations. So many things can happen, so you need to retain. You can't take the entire net profit and give it to the shareholders, and you have to think of it really wisely. And this is where economics is going to play a really big role. So you're going to assess the markets, you're going to assess the different GDPs of the country. You're going to see what's happening globally. If you are multinational company, if you're part of a multinational company, you're really going to look at the world around you. Even if you're a small scale company, you really need to look at the what's happening around you, around the globally, and what's happening to the stock market. All these things play a role, and depending on these analysis and different ratios and things like that, you're going to make a decision if you're part of the financial management team, how much is going to go into dividends for stockholders, and how much is going to be retained for profits. That's okay, Walt, I understand. Objectives of financial management. Okay, who can quickly tell me, if there's anyone who would like to tell me what is really the objective of financial management? Okay, anyone, if you want, just put your hands up, and definitely I would love to hear your thoughts on the objectives of financial management. Objectives of financial management means, what is financial management end goal? Why is there? Okay, one of it is to ensure that regular and adequate supply of funds uh, are there, to ensure that there is dividends or returns to stockholders, to make sure that funds are optimized, utilized. So you are going to take it and you're going, if you are part of the financial management team, you're going to see exactly how are you going to use the money you have got. Okay, how are you going to optimize it? You know, sometimes like I said before, it's not minimum spending per se, it is the best return, what is going to gain the best profit for you. Okay, optimizing it. And then from there, you're going to ensure safety of investment. That is here, there's a good example. Funds should be invested in safe venture so that adequate return can be achieved. If there's anyone who could tell me what that means. Okay, what does it mean to ensure safety on investment? Okay, what does it mean, safety on investment? Anyone? Okay, so basically safety on investment is that you're making sure that when you're looking into invest something, that it is safe, that you're not going to go into a huge loss. When you're looking into investing something, you have to weigh the pros and cons and realize if you're going into a loss by any chance, how much is your loss? Okay, so if when you're in the financial management team, it is not only about making profits. You have to kind of see, okay, if you're going to go in a loss, how much is that loss going to be also? Meridian, you want to go ahead?
Yes, hello. I just want to share some examples about
Please.
how the financial management works. Yeah, for example, says the CEO of skincare or skincare company wants to introduce a new product like maybe a soap or a facial wash.
Very good.
She'll call her team or his team to estimate the cost of producing the specific facial wash or the soap, and the financial manager to determine where those funds should come from. For example, a bank loan or some investment like that. And the financial manager will acquire those funds and ensure they are allocated to manufacture those specific soap in the most cost-effective way possible.
Mm-hmm.
Well, uh, assuming that the soap sell well, and then the financial manager will gather data to help the management team decide whether to put the profits toward producing more soaps.
Mm-hmm.
Start a line of something like a serum or related to those soap and pay a dividend to shareholders or take some actions. Throughout the process, the financial manager will ensure the company has enough cash on hand to pay the new workers producing the soaps. And she'll also analyze whether the company is spending and generating as much money as she estimated when she budgeted for that project.
Thank you, Meridian. Absolutely. So you're going to see whether it is good to launch the product or not. Okay, Joyce, do you want to go ahead?
Yes, ma'am. I would like to bring another example about ensure safety on investment. Like I'm using Facebook for this example. Facebook, knowing like a social media, and they take money from advertising on the Facebook, right? But why they change the name? Facebook become Meta. We asking the question, right? And that is ensure safety of investment. Facebook use all the money for Meta because Metaverse, like uh, NFT from like a new world, you know. So this is the right way or the wrong way? Why they put all the money to a new world like that or virtual world like that? And I think like a shareholder would bring the question like, you use our money for like something risky like that, and why you don't continue put the money in the successful in the past, like using all the money for advertising. So I think that the ensure safety on investment, we must to think about what we do or what the decision, and like, is it safe? You put the money but don't bring anything back, or that's a long term or that's a short term.
Definitely.
So that's what I'm thinking.
No, that is true. So you're going to think it is how long it's going to be, how long are you going to earn from your investments, how long, whether it's going to be feasible, or is it going to be how long is it, should you invest? So it's a good example about Facebook. Definitely. Thank you so much, Joy. So functions of financial management also goes in functions of financial management is estimate of capital returns. Okay, so estimate of capital returns. What exactly is estimates of capital return? Estimate of capital return is where a finance manager makes an estimation regarding capital requirements of the company. Okay, so estimations of capital requirements. I'm really sorry, I was got disturbed with these lights and everything. Uh, Estimation of capital requirements is that, okay, now we are going to go back into the cream, buying the cream example. What is the capital you need to make this cream, this product? Okay, what is it that we need? And based on that, we are going to really, if you're in the financial management team, you're going to think, okay, this machine is needed, but we don't need the premium version of the machine. We only need the basic version of this machine to make a profit. The premium functions are not necessary. When it comes to bottling the cream, we're going to think of what kind of bottling equipment do we need? Is it required or not? It is where you're really going to look into it and see, is this required or not? Okay, and that is what is basically about. So estimation of capital requirement is where of the company, and then at the same time, you're going to be looking at the cost, profit, and the future programs, the policies concerning it. Estimations must be made on the adequate manner in which increasing the earning of capacity. You have to understand increasing, sorry, here I had to move that, increasing earning capacity of the enterprise. So when we're talking about capital, we are thinking of in two ways. We are thinking of capital being about financial capital, that's monetary capital, and then we can think of equipment and things required also for the production. Okay, so you're really looking at it in an overall picture. Okay, determination of capital composition. What is capital composition? Okay, that is how do you, the long-term, short-term debt and equity and everything together, together is how is your capital compiled or put together is what capital composition is all about. Okay, so here you have made capital structure has to be decided. This involves short-term and, sorry about my line, short-term and long-term debt and equity, analyzing it. How are you going to think about your capital? How are you going to combine it, compensate, or make, kind of see which percentage goes in it, how much of long-term debt, how much of short-term debt, and then what is the equity. All this put together is what capital composition is all about. Again, it will depend upon the proportion of equity capital a company is processing, and additional funds which has to be raised from the outside parties. Okay, what does additional funds which have to be raised from outside parties? So we have the capital composition. Okay, how are we going to gain this? Now we have sorry about that. Now we have decided, now this is what the capital requirement is all about. Okay, we have decided this is the amount of capital we require. Now, how are we going to arrange it? We will be able to put certain percentage from ourselves within the company, from the profit we have earned, from the shareholders, the investors, and things like that. But at the same time, we are going to basically look at, if it's not enough, how are we going to look outside? We can look at bank loans, we can look at more investors, we can look at selling shares. So many ways are we going to take in and kind of build up our capital. And that is what we call capital composition. That is composing. You're going to take it all together and see what is the percentage. Then again, one of the functions of financial management is choosing the source of funds. Okay, so now we have gone from estimating the estimation of capital requirements, and then we have gone to determination of capital composition. And now what we're going to do, where are we going to get the funds from? Okay, what are the sources of funds? Okay, if you're going to have additional funds, again, issue shares, loans. Okay, if you're going to look from outside, this is what it is about. If you're going to choose from the capital composition, if you're going to get funds from outside, like I said before, we issue shares, or we take loans, there are bonds, then we have investors, so many things we're going to do to make sure that we need the finance that is required to make sure that we get the capital to go forward to make sure our business is profitable. Okay. Then investment of funds is also under functions of financial management. The finance management must decide how to invest it. Now you have got it. Now how are we going to invest the money? On which capital? How are we going to invest this money, the capital, the finance, the money that we have got? How are we going to invest it? Again, we're really going to think about it. We're really going to analyze it. What is the best way to invest it? Okay. Disposal of surplus. What are we going to do with surplus? Disposal of surplus. Okay. We have, again, remember that disposal of surplus means you're not going to spend all the profit you have made. Okay. What we are going to do is you're going to divide it into two. Are we going to do it dividend declaration? Suddenly you have a lot surplus, dividends or surplus. Now you have made a lot of profit because of your finance management and your creams have worked out. Everything is going good. So what are you going to do? You have a lot of, what are you going to do with this surplus of profits that are coming? You can have dividend declaration. Okay, it includes identifying the rate of dividends that you're going to pay for your shareholders or other benefits like bonus. So this is when you get a bonus. If your company has done really well, you get bonus. The stockholders are happy, they get their dividends. And then a certain percentage, every good company, every good financial management will have a section where they retain a certain amount of profit. Retaining all the profit is also not good, because no bonus, no happy employee, and no happy employees means that no work is going to get done properly and you're not going to get too much later. So really keeping everything to yourself, unless you're a small business owner, and then it's a different situation altogether, right? So make sure that you divide your surplus into two, dividend declaration, or you give bonuses and things like that, give to the stockholders so they wouldn't sell off your shares as much, and they will keep investing in you, and you are going to be, what they call the blue chip companies and things like that. And then retaining of profit is that you're going to put a certain amount of that profit away, so that in case for future investments, for future situations and things like that. Okay, management of cash. Now, the bottom of all financial management is management of cash. It all depends on the cash inflow, the cash outflow. So management of cash is where you're going to see about everything from the water bill to the electricity bill to the salaries to traveling to different liabilities, making sure you have payments on time, purchasing raw material. If you are a manufacturing company, you'll have little different other expenditures, controlling them and making sure that the inflows are higher than the outflows, but the outflows are done in a very proper, very good and organized way so that the company is not going to suffer. If the cash flow outflow increases and if the cash inflow decreases, what happens? Here's my question to you now. What will happen if the cash inflow reduces, if without the proper management, and without that the cash outflow increases? Inflow decreases, outflow increases. What's going to happen? Yes, Marjorie.
I think the company will going to be bankruptcy.
Yes, bankrupt. Rhoda also has said the same thing. Thank you so much. On thread per meter or per cone. It depends on how much it is. So each, say if you take a rivet, how much is it going to spend? How much are you going to spend on it? No, you can't have it more than, say 50 cents per rivet. Okay, things like that has to be really thought of, and that's what we call financial control. You put a budget, you put a line, and you say, no, you can't spend beyond this point also. Okay, and that can be done through techniques like ratio analysis, financial forecasting, profit controls. You are going to have budget control. All these things are going to be put into place. You're going to see, okay, I can afford to spend this, and you can't afford to spend it. If you can't, then that's where the financial control comes into place. Okay. Second. Then functions of finance. Okay. Here we have functions of finance management, and now we are going into functions of the finance itself. So here first we were managing it. How are we going to do it? Now we're really getting into it and talking about the cost control. Okay, what is cost control? That is like what we talked about the budgets. Okay, we are going to say we need to have cost control. That is, okay, we'll give you a traveling allowance, but this is it. It's only for 100 kilometers, or you are only going to get 30 liters of 30 liters or 30 gallons of petrol per month, things like that. You're going to have cost control. Okay, so here you're going to say top tier companies are really, they really face issues if you don't have cost control. Say even if you are a CEO or someone, if you don't have proper cost controls, sometimes what happens is the top management would spend too much, and then it affects the company. Okay, so cost control is very important, and cost control, I want everyone to understand that it happens throughout the company. It is not just top level, middle level, or anything. It is spread across the company. From, if we go back to the bag manufacturing company, from the thread, like we talked about, to all the way to traveling, food costs, electricity costs, water costs, everything, cost control has to be implemented. If you don't implement proper cost control, what will happen? The company is, again, like all of you are going to say, is not going to sustain properly. It's not going to, because then what will happen is, if the cost is not controlled, then the outflow is going to be more than the inflow, and the whole base of having a company is to make profit, right? So you're not going to be making that profit if the cost is not controlled. Okay. Again, here is has to be a synergy between the various processes, and this is where finance functions can play. Okay, so synergy. What is synergy? That is where it's in sync. I'll give you guys a break in about 5 minutes. Okay, just as I finish these couple of slides, I will give you guys a break. Just give 5 minutes. Right. So functions of finance is basically where you oversee the organizational process at a macro level and a micro level. Okay, you don't, in finance, you don't only think, oh, it's going to be Irene, want to tell, is there something that you would like to say? Okay, so here about the functions of finance is where you're going to look at the whole project, whole thing, whole company, the whole finances, cost control. sorry about that. And then I'm going to basically after, sorry, I got a bit disturbed. And then it's going to be where you're going to see what is the best for the company, and that is the basis of financial function. So I'm going to go into taxes and pension schemes. That's also another part of finances. We just talked about cost control and how important it is. And now we are really going to go into the next tax activities and pension schemes the moment we come back from a break. Okay, so take 15 minutes. I will put the Singapore time on, and after that, we'll come back in 15 minutes. Okay, all right, guys. See you in 15 minutes time.